Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't have to, and today we are talking about the latest projections from analysts regarding Microsoft's MSFT stock. We're also going to talk about Amazon's AMZN stock, as well as Disney's DIS stock. We're going to be going over all of these companies' future earnings reports and projections so we can trade or invest off of the volatility of the stock price so we can get amazing returns. This is episode number 2 of the top 100 stocks. In the previous episode, we covered stocks like Tesla, Ford, and Apple, so now we are on Microsoft, Amazon, and Disney. For more videos like this one, remember to go and smash the like button right now, subscribe if you are new, comment your thoughts down below about these stocks, and without further ado, let's begin. Recently, Microsoft Corporation, ticker symbol MSFT, has jumped by around 2% for their stock price due to very positive outlooks and forecasts regarding estimates for their upcoming earnings report. Currently, Microsoft's MSFT stock trades for around $296 per share. The low-end price prediction, according to analysts, is $299. The average price consensus among analysts is $371, and the high-end price target for the end of 2022 is $425 per share. I always love to invest in stocks that are currently trading below their low-end analyst price target, because this way it gives us a nice cushion just in case the low-end price target ends up coming through to fruition. If you didn't know, Microsoft is an extremely large technology company that supports a range of software solutions, business platforms, various devices, services, and much more. According to Bank of America analyst Brad Sills, he said that Microsoft is one of his top stock picks, especially before their upcoming earnings result, which we will talk about in this video. Even a Citigroup analyst is very bullish about Microsoft's upcoming earnings report, and a Cowen analyst even thinks that Microsoft will more than outperform the overall market, which is why he has put in outperform rating. The Cowen analyst mainly focuses on Microsoft's amazing Office 365 platform, which he thinks will become the world's largest and biggest software as a service business. These bullish projections from analysts also comes from the tailwinds of a recent acquisition between Microsoft and Activision Blizzard, ticker symbol ATVI, and I previously did a video about that if you wanted to check it out. This could literally change the gaming industry and generate an entire new stream of revenue for Microsoft on top of their extremely important cloud business. The Bank of America analyst named Brad Sills says, "We believe that Microsoft is well positioned to generate sustained low double-digit growth in the coming 3 to 5 years, led by continued adoption of Azure Cloud Infrastructure Platform, cloud-based Office 365 productivity suite, and more profitable games and Game Pass revenue in Xbox." The analyst also noted that Microsoft's Azure Cloud Infrastructure Platform is going to be extremely important as they start to scale more revenues, and he believes that the company could post growth as high as 49% for this particular segment. Currently, the analyst is anticipating that Microsoft is set to report $50.7 billion worth of revenue, which would equate to around a 17.6% increase from the year prior for the second quarter of 2022. And Microsoft earnings report is going to be announced very soon on January 25th. The analyst has actually increased his revenue forecast for Microsoft from $47.7 billion to $50.7 billion, which is fantastic news. However, he did not raise his price target for the stock, and he maintains a buy rating of $365. The Cowen analyst, who is Derek Wood, has a very similar price target of $360 for the MSFT stock. But on a more positive note, the Citigroup analyst says that the earnings per share for the entire year is going to come in at around $9.69 per share, which is amazing news, and he has lowered his price target from $407 down to $376. However, even though he lowered his price target, this target is still more bullish than the two other analysts. Microsoft is in a fantastic position right now, and it's currently ranked as the second largest company in the entire world by market cap, coming in at $2.2 trillion, right behind Apple. And of course, we talked about Apple in the prior video. Analysts have a lot to say about Microsoft, so instead of going through all 21 analysts that I studied, I'm just going to give you the average price targets, price predictions, and earnings per share for their upcoming earnings report. So the consensus forecast for the earnings per share for their earnings report is $2.31 for this quarter. The revenues are anticipated to be $50.88 billion on average, and both of these metrics are actually a comparable increase from $2.03 for their earnings per share and $43.08 billion of revenue for the same period in the prior year. So this is fantastic news that although this is a gigantic company, it is continuously scaling. But now let's talk about Amazon. Amazon, ticker symbol AMZN, currently trades for around $2,852. The low-end price target, according to analysts, is $3,771. The average price consensus among analysts is $4,108, and the high-end price prediction is $5,000. And I am extremely bullish on Amazon stock, especially because its current stock price has pulled back, and it gives us a considerable margin of safety from their low-end price target. Amazon's earnings report is set to come in on Thursday, February 3rd, and in the last quarter, the company actually missed Wall Street's expectations, which has caused the stock price to pull back. However, I personally just use this as a fantastic buying opportunity. Throughout 2022, the Amazon stock has actually declined around 9.1%. However, this is no surprise because major indexes such as the S&P 500 and the Nasdaq have fallen around 5.9% and 9.5% respectively over the exact same period leading up and into 2022. As you can see from this chart over here, their revenues are set to scale very nicely with an increase of around 9.7%. However, their earnings per share is set to decline. Now, Amazon's management did not provide us any earnings guidance for this quarter. However, they did give us their operating income statistics and their revenue metrics of what they think that the company should actually obtain. For the fourth quarter, the operating income is set to range anywhere from $0 to $3 billion. Now, when I say zero, I just mean that it's below $1 billion. And this is actually down from a year ago where Amazon brought in around $6.9 billion of operating income. Amazon did provide us revenue guidance. However, analysts think that the revenue is going to increase around 12% year over year to $121.2 billion, with earnings per share set to fall 33% to $10.53. So overall, this is not going to be a fantastic quarter for Amazon, but the stock price is trading at such a discount, way below their low-end price target from analysts, that the stock has fantastic upside even if they miss on their earnings. And this is one of the reasons why I personally am invested in Amazon. Amazon also has other catalysts going on because they are set to open up their own clothing store in a physical brick and mortar store. It's not going to be over the internet. It's going to be an actual physical location, and they're setting up their first physical store in Los Angeles in a suburb of Glendale. The great news is that this company is actually supposed to open up later this year, which is fantastic news, which could act as a catalyst to further increase the stock price. This store is going to sell clothing to both men and women, along with shoes and accessories from a plethora of various brands that are both established brands on top of emerging brands. The managing director of Amazon Style said, "You'll find everything from $10 basic to the designer jeans to the $400 timeless piece." Basically, they're saying that this store is going to be a Walmart mainly just for clothes, and it's going to carry everything from very cheap clothing to very high-end designer clothing. The store in general is going to be around 30,000 square feet, which is about the size of a typical TJ Maxx according to the article. The reason why this makes me extremely bullish as an Amazon investor is because Wells Fargo analysts actually said that Amazon surpassed Walmart at one point for the #1 apparel retailer in the United States, with Amazon's apparel and footwear sales set to increase in the United States by around 15% from 2020 onward, which would net them around $41 billion worth of revenue, which is fantastic news. The reason why Amazon is doing this is because they want to fix some of the problems that consumers have experienced with traditional retail stores. For instance, when you go into a clothing retail store, there are racks everywhere and it can seem very disorganized and cluttered. However, for this particular store for Amazon, shoppers are going to heavily rely on their smartphone and various devices to actually use the store. And what do I mean by that? Basically, the store is only going to display one type of item, and then you're going to be able to scan that item or something next to the item with a QR code, and you will be able to view all of the sizes and colors that this particular article of clothing or accessory comes in. And to me, this is going to enhance the layout of the overall store, and they'll keep everything else that consumers need in the back of the store, and they'll just bring it out. Amazon is also rethinking fitting rooms. They're going to add touchscreen displays in the fitting rooms where you can request different styles and sizes or colors of a specific article of clothing, and the employees that work there will be able to go in the back and get those for you. This will allow consumers to shop even while in the fitting room, and this is thus going to increase revenues and make consumers buy more items. So to me, overall, this is a fantastic idea by Amazon, and I think it could be extremely lucrative for them over in the long run. However, this is going to be a future catalyst when the store actually opens up, which should increase the stock price on top of their earnings report, so we can be very excited for that. And again, I am a very bullish Amazon investor. Now I want to talk about Walt Disney stock, ticker symbol DIS. Currently, the DIS shares trade for $137 per share, which matches the low-end price target for analysts of $137. The average price consensus ranges anywhere from $195 to $196, and the high-end price target for Disney stock is $220. Disney, if you didn't know, is a worldwide entertainment company that literally basically does everything from amusement parks to food to movies. Recently, Disney stock has shed around 15% from its overall value since 2021, so should investors take this as a good buying opportunity? Well, let's see what analysts think about the stock. Right now, analysts are pretty optimistic overall about the stock and its price appreciation over the next 12 months, with a consensus price target of $198 on average, according to some analysts. This would give investors around a 31% upside from the stock's current price, which would beat overall indexes very handsomely, so this could be very lucrative for investors to invest into Disney stock right now. However, let's go on so we can balance both the bullish and bearish sides of this particular company. Should we invest into Disney stock right now? Well, the bulls say yes, of course. Its parks and parks experiences have increased their revenues by a very handsome amount ever since the lockdowns. The parks and their experiences have brought in anywhere from $5.5 to $6 billion, and that gave them an operating profit of $640 million, so extremely lucrative. We also have to focus on the Disney Plus platform, which is Disney's streaming service, which is an extreme competitor to Netflix. Just listen to what this article says about comparing Disney Plus to Netflix, and I quote, "After launching in November 2019, the Disney Plus streaming channel now counts 118 million subscribers, which is an incredible feat. It took Netflix 10 years to reach that exact same number of subscribers, and management anticipates that Disney Plus is going to have 230 million to 260 million customers by the end of fiscal 2024. So this is going to be an extreme competitive advantage in the overall entertainment market, especially as they continue to contend with Netflix. And if you didn't already know, the Netflix stock price has absolutely plummeted based off of this news and a few other things that are happening with Netflix, but this is on Disney right now. I will talk about Netflix in a later video. However, I do want to weigh this against the bearish argument against Disney stock, because historically, Disney stock has underperformed the overall stock market, specifically the S&P 500, by a fair amount, and this has happened over the past 1, 3, 5, and 10 years. So technically, you would have made more money as an investor if you invested into, say, ETF VOO, which tracks the S&P 500 instead of investing into the single stocks such as Disney. However, now let's talk about their earnings and what various analysts think about the 2024 forecasts for Disney, and why Disney stock could be a great large cap growth pick for 2022. For Disney's upcoming earnings results and their earnings report, which is scheduled to be on February 9th, their earnings per share is supposed to be 64 cents a share, and their revenues are set to come in at around $20.98 billion. So we are looking for revenues and earnings per share beats for the stock, and if they end up getting these beats, we could see some fantastic price action and price appreciation well into the future. Wells Fargo, as an institution, and various analysts say that the stock is at least worth $196, which means that it is trading at a fantastic discount right now. However, what are their earnings per shares and revenues going to be in the future? Well, the consensus for 2024 is about $100 billion worth of revenues and a $7 earning per share, which is absolutely insane. This means that Disney is set to scale very, very nicely, and if you want to invest in Disney, right now could be the best time to do it before they start scaling. So we would want to get into this early because that is going to give us the most growth for this particular company. TipRanks surveyed around 21 analysts, and the overall price target for DIS stock is $196, very similar to the average price consensus that I gave earlier, as well as what Wells Fargo is currently pricing the stock at, which means this stock is a moderate buy rating, which is fantastic news. The company is set to grow and scale at a very sustainable growth rate over time, which means it could be a fantastic long-term opportunity for long-term investors. However, out of these three stocks, I am extremely bullish on Microsoft and Amazon and not so much Disney. If I had to choose two of these three stocks, of course, Amazon is going to be my number one pick, followed by Microsoft, and then I would invest into Disney if I didn't have any other choice. But I would love to hear what your thoughts are down below. Remember to go and smash the like button right now, subscribe for more videos like this one, and I will see you in the next YT video.